technical advice to climate finance NGOs. I wasn't involved in the research, but I read it and thought it was really interesting because it added a kind of a third leg to the divestment stool, as it were. So originally divestment was about risk management and removal of a company's social license, so that kind of political point. But now this research I think is really interesting because it shows that divestment can actually reduce carbon emissions of the divested companies too. With the social license side of it, that is a political act, and so a lot of investors are uncomfortable with that, both asset owners and asset managers. And so what this research does is it gives investors a solid scientific backing to using divestment as part of the tool, not as an alternative to other investment tools, but as a complement to company engagement, lobbying governments for climate action, and putting new money into green businesses. In a moment, I'll hand over to the academic team to introduce themselves and present their findings. If you have any technical difficulties, they're hosting the call. And so if you can just message them. The Q&A function is disabled because we'll be using Slido. We're going to use Slido because what it does is it allows you to post questions, but also to upvote other people's questions if you think they're really good. And that way we'll ask the most popular questions, not just the first one submitted. And obviously these questions can be related to anything, the input assumptions, the statistical analysis, the investment implications, whatever queries you have. So I'll just hand over to the investment team the research team to introduce themselves and give the presentation. Thanks very much.
Okay, are we going to introduce ourselves one by one, or?
I think you can do it for all of us, Martin.
So I'll start sharing my screen. And you should see my presentation here, where Marco Wilkens, Martin Rohleder, that's myself, and Jonas Zink from the University of Augsburg. And we have worked on this research for the last, let's say, three and a half years, and have recently published the paper in the Journal of Banking and Finance. It was released in January of this year, and the name of the paper is "The Effects of Mutual Fund Decarbonization on Stock Prices and Carbon Emissions." Couple of words before we start on our background. We've been doing research on classic finance, especially capital markets research. Marco has done it for more than 20 years. I have done it for more than 10 years. And in that area, we looked at especially mutual funds, what drives performance of mutual funds, how can we measure performance of mutual funds, and so on. What is the behavior of fund managers? What is the behavior of fund investors? And for the last, let's say, 5 to 7 years, we started also research on sustainable finance, specifically on climate finance. And of course, it's a nice thing to combine the two topics, mutual funds and sustainable finance or climate finance, to pool these competencies and look at the behavior of mutual funds regarding climate finance. So what we did is look at mutual funds and their behavior in decarbonizing their portfolios. What do we look at? We look at 4,600 roughly actively managed domestic US and European equity funds, which is the, let's say, the relative or the relevant universe of mutual funds. All other mutual funds, there are more, either have very short time periods or didn't report their holdings, because we look mainly at the holdings positions of these funds to identify which stocks they are selling, which stocks they are buying. What stocks do we look at? Here we look at more than 10,000 US and European companies. Also, once again, the relevant universe. held by these mutual funds. And here we look at stock prices from the accounting data, and we look at annual carbon emissions. And here we look specifically at scope 1 and 2 emissions. So the relevant mutual fund and stock universes of the most important markets, the US market and the European market. Sample period is 2010. This is when the carbon emissions data becomes available and also reliably available. To 2017 is when we started this research. And with this data, we ask several questions. And the first question that we ask is, how easy is it for mutual funds to decarbonize? And the measure we use is the carbon intensity. Carbon intensity, as you might know, is scope 1 and 2 emissions divided by net sales. So the consumption of carbon emissions by the firm divided by the net sales. So how efficient are the firms to turn emissions into sales revenues? So that is carbon intensity. And on portfolio level, we look at the weighted average carbon intensity, which is the carbon intensity times the portfolio weight aggregated on portfolio level, gives the weighted average carbon intensity. Why do we use this measure? We use it because it is recommended by the TCFD to be used for exactly this purpose, to show and to analyze how dirty and how clean portfolios are. And with that measure, we look at how easy it would be for mutual funds to decarbonize. Therefore, we rank the stocks from dirty to clean. And if we look here on the right, rank 1, we see that the single most dirty stock, the stock in the portfolio on average with the highest carbon intensity, constitutes 24%, almost one quarter of the carbon intensity of the portfolio, but only 1.5% of the portfolio weight of the money invested in this portfolio. So by selling only one stock, which is only 1.5% of the portfolio, the fund could reduce weighted average carbon intensity by almost 1/4. And then if we go, for example, here in the middle to the 5 dirtiest holdings, which are only 7.8%, less than 8%, we would have to sell as a portfolio manager. We can reduce the carbon intensity of the portfolio by almost 60%. So that is a huge carbon or decarbonization potential of the funds that we find on average during our sample period. So of course, the second question that has to follow is, are funds actually decarbonizing during our sample period? And if they are, does it have an impact? So how do we go on analyzing this question? First, we identify decarbonizing funds, the funds that actually decarbonize. And then for these funds, we try to identify the sales they did to decarbonize their portfolios. And here to identify first these decarbonizing funds, we once again look at the weighted average carbon intensity of the funds. And specifically, we look at changes. So how strongly did the funds change their carbon intensity, and also split this VRCE change into active changes, which are actually from shifts in portfolio weights. This is what we are interested in. And passive changes, which are changes in portfolio carbon intensity due to changes in firms' carbon intensities. So we look at active changes in portfolio carbon intensity and define the 10% of funds with the highest active decrease in carbon intensity as those funds that have actively decarbonized. So in the second step, we look at the trades of these decarbonizing funds, and especially at the sold stocks of these decarbonizing funds, and define decarbonization trades as sales in the top 5 dirtiest holdings within the portfolio. So of course, only funds that are very dirty, if they are sold, the fund can decarbonize itself, reduce carbon intensity. And as we have seen before in this analysis of the carbon decarbonization potential, the 5 dirtiest holdings play a very important role. Second condition is that the carbon intensity of the holding must be greater than that of the fund, because if we sell a stock that is less dirty than the fund itself, then it makes no sense to count it as a decarbonization trade. So if these both conditions are met, we define this trade, the sell trade, as a decarbonization sell trade. And from these decarbonization sell trades, we calculate our final stock level metric, which is the decarbonization sell pressure measure. It's a quarterly statistic that looks at the number of shares which are sold by all of the mutual funds related to decarbonization. So all the stocks or all the shares of the stock sold by these decarbonizing funds. And that is the main measure that we'll be using in our following analysis. For this analysis, we divide our stock sample into 5 different groups. The first main group is the group of decarbonized stocks. These are stocks which have been heavily decarbonized, which means they had high decarbonization sell pressure, HDSP. And then we compare this main group of decarbonized or of divested stocks with control groups. These control groups are as follows. Control group 1 are stocks with heavy general sell pressure. So they have also been heavily sold, but related to other reasons. For example, financial reasons. So not related to decarbonization. And here we try to disentangle the effects of selling with decarbonization goals and other goals. As a second control group, we use stocks without any sell pressure. So the general development of stocks in the market. Then number 4, we have a second main group. These are stocks which have high carbon intensity and have been divested, so they have high decarbonization sell pressure. This is a subgroup of group 1. And this main group 2, we compare mainly to control group 3, which are also stocks with high carbon intensity, but which have not been divested. So they have low decarbonization sell pressure. And here we try to disentangle the effects between divested stocks and those stocks that are also high carbon intensity. So they have also, for example, influences by policy or market movements or market changes, for example, in legislation or carbon prices, energy prices, but not by the divestment movement. And with these different groups, we do 2 event studies. And these event studies look at stock prices. So how does this divestment, mutual fund selling of high carbon intensity stocks impact stock prices, and how does it impact carbon emissions? So now let's look at the first event study, that is about carbon return, about stock returns. And here we compare HDSP, so divested stocks, HGSP, high general sell pressure. So these stocks have also been heavily sold, but due to other reasons, and no sell pressure. So no sell pressure is the overall control group. And if we look at this measure, or at this group, the dotted gray line, then we see that their prices don't change much. The prices remain more or less stable. The returns are more or less, or the cumulative returns are more or less zero. This is what we expect. If there's no pressure, there should be no exceptional returns. If we look at general sell pressure, we see that in the selling event, the stock prices fall due to some new fundamental information. For example, the CEO of the company made a profit warning. Less profit than expected. So this is new fundamental information, less cash flow expectations, prices go down, but the new information is relatively well incorporated in the new price, settles on a new level, and afterwards the changes in the price are zero, so no new information. If we look at HDSP, we also see a steep price decline in the selling event, but it goes on after the selling event. So there's sustainable price decline in divested stocks, which is not due to new fundamental information in the market, but due to new opinions by investors in the market, new preferences by investors in the market. So there is less preference for these high carbon intensity stocks. They are divested and their prices continue declining. This is very important because this further decline, the sustainable decline in the price, is an important incentive for the firms to change their behavior. If there is not such a steep decline, not such an ongoing decline in the stock price, there is no incentive for the firm managers to change behavior, to change carbon emissions. But with this ongoing decline, there is a strong incentive. If we compare high carbon intensity stocks that have been divested and high carbon intensity stocks that have not been divested, we also see a huge difference, because here in the black solid line, we see that these divested high carbon intensity stocks have a even stronger price decline than the overall group of divested stocks, whereas non-divested high carbon intensity stocks show also a slight negative return, but not the steep decline. And this slight negative return could be due to new policies, new regulation regarding carbon emissions, higher carbon emissions prices, and so on. So there is a small negative return for this overall group of high carbon intensity stocks, but there is a considerable additional effect of divestment, of mutual funds selling these stocks en masse. So is it enough, this pressure here, to change carbon emissions of these firms? Therefore, we look at the next event study on carbon emissions changes. Here, once again, we compare divested stocks with general sell pressure, also heavily sold, but not due to decarbonization, and no selling pressure. So if we look at these two groups first, once again, that have not been decarbonized, we see that their carbon emissions increase over our sample period more or less unchanged. From 24 months before the selling event to 48 months after the selling event. For example, here for no selling pressure, carbon emissions change by more than 10%. Now, if we look at divested stocks, we see that before the selling event, the change or the increase in carbon emissions is more dramatic than for the other firms, which is of course expected because these are the high carbon intensity stocks, which are afterwards divested. But after the divestment, we see that the carbon emissions of these divested stocks don't change at all. They remain here on this level. And then after 36 months, after 3 years, they even drop below the level in the selling event, which is, of course, once again expected, because for the management to take action and to implement new production technologies or other saving measures for carbon emissions, of course, this takes time. So we see here for these divested stocks that on average, they increase their carbon emissions less than all other stocks, and they decrease also after a while under the previous level. Then if we compare as a last event study, the divested high carbon intensity stocks and the non-divested high carbon intensity stocks, we see that these non-divested high carbon intensity stocks also have this kink, also increase their carbon emissions less than the total sample here. So it remains here, the black dotted line on this level here, a slight increase, and that also can be attributed to changes in policy, changes in regulation, changes in carbon emissions prices, and so on. So this is the general impact of these policies on high carbon intensity stocks. But once again, we see that the divested high carbon intensity stocks have this additional effect, this additional reduction of CO2 emissions due to divestment. Okay, of course, we did not only do these event studies, we also did a number of additional analyses and robustness checks. We did panel regressions controlling for other firm characteristics, for the financial performance of the firms, for carbon emissions, the level for carbon emissions changes before the divestment, for the sales growth after the divestment, and all of this doesn't change our results. We use in these panel regressions alternatively firm fixed effects, time fixed effects, industry fixed effects, country fixed effects, and also time within industry fixed effects, time within country effects to look at different impacts of these policy changes within different countries, within different industries over time. All of this doesn't change our results. We look at an alternative explanation. Here we look at the effect of shareholder intervention. Specifically, we look at shareholder proposals that occurred simultaneously to the divestment, but a date doesn't change the effect. We look specifically, once again, at financial selling reasons, so index delistings and earnings surprises, which doesn't change anything. We look at the long-term decarbonization of funds. So here we look at a subgroup of funds that decarbonized long-term, so where the weighted average carbon intensity doesn't rebound to the level pre-decarbonization. We look at stocks that have been decarbonized more frequently, and of course here the effects are stronger than for those that have been decarbonized only 1 or 2 times. We look at different performance measures. We look at cross-sectional cuts and time series cuts, especially Europe versus the US, but the effects are more or less similar in the 2 markets. We look at changes in carbon intensity instead of carbon emissions and so on. So many more robustness checks. Okay, so yeah, this is a short summary. I don't think I have to go through this to save time for the discussion. And if you have any questions, Joel asked me to show you this this link. Go to Slido and use the code 816-783 to take part in the discussion.
That's great. Thanks so much for that presentation. That was really, really useful. I'm sure people have got a lot of questions.